So last week we called this. Well, I think that was on this was where we were on Friday, where we outlined these fair value gaps. And we said the dollar was going to reach out for these fair value gaps. And then I said,
Yes,
yeah. And then I asked if we could see any internal range liquidity. I think Elijah mentioned this fair value gap, Abi? And
yes,
then
sir. I did.
Elijah mentioned this fair value gap. And then I don't know, this was the fair value he was mentioning. And then we I explained that I wouldn't want to see Monday go into this fair value gap because although this high, you can see that this high here was not taken yet, but this high was taken. But with context, if you notice, market is running from this consolidation. As soon as it took this high, what happened? We had a little retracement here. It took out these highs, so we had a little retracement here. And when you see small retracement, we call this institutional order flow entry drill. That is telling you that price is quick to reach for a particular point in price. Like when you see market moving like this and you see little retracement, it's saying that price is going there too fast. So that's why I said if price should break, let's go to Europe quickly. Remember I told you that we identified this fair value gap here. We can see this fair value gap. How I said this is an institutional order flow entry drill. How do you identify institutional order flow entry drill? When you see a very huge fair value gap and then you see price touching it small, you see this tap. So it is an institutional order flow entry drill. Most times it's telling you that market wants to go in a certain direction. This is telling that institutional order flow is bullish. Once it's breached, it's telling that the institutional order flow has changed from what it was before, in this case, bullish, to what? Bearish. So I mentioned that once we see this being taken, there's no need. No, I think we in the weekly time frame, we're calling this order block. I don't know who sent me a picture. I think maybe it was Elijah. Or I don't know, maybe I can't remember. But someone sent me a picture outlining this bullish order block. Or we're thinking that, or the person who sent it had the expectation that price will find support to rally into this fair value gap. And then what did I say? I was saying if this point is breached here, I wouldn't want to see price even get close to it at this point. You can see this candle here is actually very close to it. So there's no now I'm only explaining this because time price is fractal. Many times you will see this in the lower time frame. This is how you can read price. And if you understand this market movement, you can know how to enter and when to place your stops. Like I said before, stops are not placed based on your calculation. Okay, because I just want to reach 0.5%, and I'm entering here. So therefore, my stop will be here based on the pips I've calculated. No, your stop should always be where you know that if market should get to what happens, the true. You say, okay, Fortune is here. Fortune Williams. Wow, let's welcome Williams. I don't know if you know Williams. Do you know Williams? Can you hear me?
Evening, sir.
Maybe it's not the Williams I know. Voice is sounding very strange. Very, very strange. Okay. Well, yeah,
Sir,
well,
this is Fortune.
Fortune. Okay, Fortune, you're not replied. How are you now?
Fine, sir.
Uh-huh.
Evening, sir.
Good evening. Thank you so much. Williams. Williams, can you hear me? Okay, maybe you can hear me. Let me just continue because of time. So as I was saying, um, prices. So where you put your stop is based on where you think the trade will be nullified. What, where do you think price will get to that it changes your bias? If you notice, anytime I give you analysis, I always tell you, that, okay, if price gets to this point, then I'm no longer bullish or I'm no longer bearish. I'm saying all these things so that you also, this is how you build the anticipatory skill. This is how you build bias. There's some things you look out for. And sometimes I also call certain days bullish or bearish. But then when I go to a smaller time frame, there's certain things that I look out for and then they help me know that okay, market has changed. Most times I wouldn't come to the groups and start thinking that okay, I was seeing this like this. Oh, But now it has to, like, it happens very fast because most of the trades I take are scalp. You notice that the day will be bullish for that day, and I'll take a bearish trade for London, and I'm out. That's the kind of trader I am. So you also will know the type of trader you are. And sometimes that I'll be buying and you will be selling, and you will both make profits. So it's not necessarily, so that's why I don't believe in what do they call this thing? Um why will I forget the name of these things? Signals. Yeah. I don't really believe in all those signals. If you do it, fine. If it works for you, fine. But personally, I'm actually against it because you need to, it's very common knowledge. You teach people how to fish, don't give them the fish. And it's very true. So someone like Elijah or let's see, Samuel might be selling and I'll be buying and both of us will make profit. So it's based on the type of trader we are. And I've been saying it, but my goal is to build you to that point where you would not need any lecture from anybody. You will not need, like me now, I can't go and start buying any course. Like, what am I using the course for? I've learned everything I need to learn. When I mean I've learned everything I need to learn, I have what I need to go and learn about myself and the market because that's where the true learning starts. When it is you and the market. That is when you begin to learn your trader. That's when your inner trader is unlocked. You begin to know yourself because you are a unique trader. There's nobody like you in the market. You are unique. So if you are trying to copy anybody's trading style, trying to follow everything they are doing, everything they say, you are really doing yourself a peril, or you're at your own peril, rather. So, like I was saying before, I explained how that if price gets to this point, probably we wouldn't be seeing. I would not. Many of you were thinking price is only retracing. I think it was this is Thursday now. This is where price was last week. So we're thinking that okay, price would find support in this bullish order block, and then probably this was the week where this wasn't there. So let me just take it out. This was how price was looking. Let me take all these things out. So this is how it was last week. So we're thinking this order block or this order block will hold price for, pri for price to rally higher. But I said no, that wouldn't happen. Why? Because we can see an institutional order flow entry drill here. So this alone, as price gets close to it, it's telling that the institutional order flow has changed. So when you see displacement, and how you know there's displacement when there's creation of fair value gap, it's saying that price wants to go in that direction. But once price starts falling close to it, now I'm saying this and they just look, okay, what is this saying? It's just saying nonsense. Or when I mean I'm saying nonsense, nonsense doesn't mean something that is bad. Nonsense is something that doesn't make sense to you, so it's nonsense. That's why if somebody is speaking French to you, it's nonsense because you don't understand it. So it's what you can make sense from that we call sensible. But if you can't make sense of something, it becomes nonsense. So at this point, it might be nonsense, but just try to remember that I said you should know that flow tells you the market direction. So if market is moving at this point, you can, let's say this high has already been taken. It is very safe. Let's say this is a 1 minute time frame. It is very safe for you to put your stop loss here. Let me expand it for those of us using our phones. Let's say market creates this huge displacement, and then you see this little tap into this fair value gap here, this huge range. Once price breaks this high, it's very safe for you to move your stop here. So telling you that if price should come below this low, this trade idea is is nullified. I mean, which language will I use now? Do we understand? Because this here is telling you that price.
Mhm.
Who is saying something? Blessing.
No, no, no.
Okay. Okay. So it's telling you that this price is in a hurry to get to a certain point. And most times we see it in the one, this happens very well in the 1 minute time frame. You see price moving very fast because many times if you take your trade idea from a 5 minute order block, don't expect that trade to last too long because you are taking the idea from a 5 minute order block. That time frame is short. Like I said in my order block video, you want to be using higher time frame order blocks because they have probability of holding price. Because this can also be a 1 minute time frame. Let's assume this is a 1 minute time frame. You can see how price is finding support in this bullish order block here. If I outline it out, let me just outline it. We'll see other, you see. So let's assume this is an order block. And this is how many minutes? 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay, 10 minutes. You can see how, let's say this was just like, let's say this is like 1 hour. You can see that it did not last too long. We assume that these candlesticks are all 1 minute candlesticks. This is a 1 minute time frame. You can see how it did not last. This is why I always don't like when you take trade ideas from a short, smaller time frame. We want to go a higher time frame so that it gives room for you to see the market and benefit from huge range market moves. But if you look at it from a daily perspective, you can see how many days this bullish candle held price. 1, 2, 3, 4, 5, 6, 7, 8. For 8 consecutively days, you can see how price was bullish as a result of this bullish order block. So I've clarified that. So let me go back to what I've been talking about. Now, I said I wouldn't want to see Monday do what? Trade into this point. Why? Because we've not taken external liquidity. Although we've taken it here, but according to context, we are looking at this range from this low to this high. So we're using this high from this high here to this low. We expect that once this internal range liquidity has been taken, price can now rally lower. So we can see how Monday breached this high. I loved it. I was so happy when Monday ran through this high. It just gave me more confidence that price wants to keep going higher. And you saw how it pressed higher Tuesday, Wednesday, Thursday, and then Friday. Friday created what we call TGIF model. TGIF model is simply when Friday retraces, I think, is it 25% of 50? Yeah, 25% of the range that was created. So look at this is Monday, the range. I'll return it for us. This is Monday. And this is Friday. So Monday formed the low of the week, and then Thursday formed the high of the week. And we can see how Friday retraced into the range. So let's see how many percent. So this is 25%. This is almost 50%. So we're like at 45% into the range of the week. So it usually happens. Let's look at this day. You can see how Friday retraced, but not that much. Here it didn't happen. But if you go to your chart, you see how Fridays usually retraces back into the range. You will notice it. So that's where we get the model called Thank God It's Friday. It doesn't happen all the time. You use context. If you see that price is let's say Wednesday or Thursday is running a long-term high, you expect that Friday will print the TGIF model. It's expected to find it here because price has taken what? Buy side liquidity and run into what? It has closed this daily fair value gap. You can see this line here I drew. Price has closed this fair value gap. We are left with the weekly fair value gap. So we are working with the daily time frame first of all. So we're expecting price to retrace into this range. So we combine context. So as soon as this high has been taken and this high has been taken and price has filled in this fair value gap, what do I expect? I expect price to keep running lower. So I'm looking at this point. I want to see how price will react here. Let me expand it. We can see this fair value gap here. I want to see how price will expand into this fair value gap. But first of all, let's go to the weekly. Let me show you guys something. Let me give you. Now, this was not how I intended starting this meeting. It was because of many people did not come early. But everything I've said, do you all understand?
Yes, sir.
Okay, thank you.
Yes, sir.
All right, very good. Then goodness, how are you? You're the only one I did not greet. How are
I'm
you
fine,
doing?
sir.
Happy Sunday.
I'm fine. Thank you, sir.
All right, thank you so much. Okay, I think everybody except Samuel does not understand. Samuel and Williams. Everything I've said so far. Everything I've said so far. Okay, good. Good. Now, looking at price, before I always say before you analyze, before you try to predict what will happen next, as day traders, scalpers, and short-term traders, except you are swing traders, you must be going to the monthly time frame if you are a swing trader. Majority, not all the time. I usually go to the monthly time frame, but usually not all the time because monthly is very slow in printing. You can know, just like the name is a monthly time frame. One candle represents 1 month. So throughout the month of October, we've been bullish. I expected that this month of October will be bearish, like fall bearish, because we saw a bearish August, a bearish September. So I expected, but we saw something happening. I think I and Fortune were discussing about how dollar was just bullish, like surprisingly. So you can be wrong and still make money, although. So we can see how price has taken this low. So I expected this low to be taken, but it wasn't. So you see external to internal is also working in the monthly time frame. Monthly took out the external range liquidity here and here. Now it's running into what? The internal range liquidity. So as expected. Now, at this point, if you look at the monthly time frame, what do you think the next month will print? Bullish or bearish? Who has an answer?
I think if it was bullish, I think it should go more bullish.
You say?
If this month closes like as a bullish committee, I think the next one should be bullish to go for those repeat calls.
Okay, so that we don't waste more time. Samuel said bullish. Okay, so we are just trying to predict the market. Probably he's saying market will run for these highs. Yeah, that could happen. But with the way, if personally I would want to see, there are many things I want to see first. Probably price might run for these highs, or price is just filling in this fair value gap to continue going lower. We don't know. But then, if you ask me, I wouldn't say we are bullish yet for these highs. Because if you go down to the weekly time frame, it depends now. It depends on what we see in the weekly time frame. Because these highs are also suspect highs. You can look at it here. These are relatively equal highs. Price could run for these highs or to resume lower to take this low. We don't know yet. Now, how can we now predict the markets? We want to work closely with what we are currently working with. What do I mean? Those words are just mixed up. I don't know why I said that. Okay. Because we are day traders, we are short-term traders, we are scalpers, and even if we are swing traders, we want to work with the current market. We don't want to bother ourselves with this high, this low, except we want to invest as position traders or investors. So what we want to do is this is a weekly time frame. We want to try and predict what will the next weekly candles range be. Where will it expand towards? Is it going to expand higher or lower? How can we predict that? We identify areas of what? Liquidity. And there are two places price goes to: fair value and buy or sell side liquidity. So if we look at markets here from this range to this range, where can we find liquidity? We can find liquidity here. Price already filling this gap. We can see this high. Okay, now everything is coming back. Let me just take this high. Take this high. Okay, I'll leave it there. Let me just take this one. And then remove this equilibrium. Okay, equilibrium is also very good. Now, from this high to this low, we can see this high here. This is a drawn liquidity, and we can also see this fair value gap. So we don't want to look at this fair value gap yet. We want to look at this high for the premium. Now, in the discount, where do you think price will go? We have this what? Fair value gap. And then we are seeing that this here is a breaker block, and we have this inversion fair value gap. So we identify our points of liquidity. And looking from this high to this low, we are at what? A premium. Now, if you ask me, I would say the next week to be printed probably would be bearish. I'm expecting a bearish week. Where am I expecting price? Who is saying something? Okay, nobody's saying
So
it.
it doesn't go.
Okay. So now, well, in a premium, we're in a fair value gap. So, and we know that the best place to sell is from a premium. The best place to buy is from a discount. So there are certain things I will look out for, and I'll explain them in the daily time frame that will help me see if price will still continue going higher. Remember, I always tell you that if this happens, then I'm bearish. I'm no longer bearish. If this happens, I'm no longer bullish. But looking at the weekly time frame, I expect the next week that to be printed should be bearish to run for where? This fair value gap here. Why am I saying that? Because we are at a premium and a fair value gap, and if price should keep running for this high, then the likelihood for this high and this high to be taken will actually increase. And I'm not expecting that to happen at this moment because we have what? These lows, and these lows. I'm not saying price will not run for these highs. It might, but there's a stronger probability that price would want to run for these lows. This could just be a retracement into this range from looking at it from the higher time frame. And then what else again? Is there anything I'm looking out for? Well, that's all. That's the reason why I'm bearish. Okay. So going down to the daily time frame, because I'm bearish, let me identify where I'm expecting price to get to. This fair value gap here. This is what I'm looking out for. Now, going to the daily time frame. So I'll outline it here. This is the weekly time frame. Let me take this out. So please, if you know you are not following, I'm just trying to go ahead and not ask questions so that we don't waste time. I don't want to take time today. So if you know you're not understanding, please just raise up your hand or just speak up. All right. And then, or if you have a different opinion, you can just speak up. All right. So we have taken what? Buy side liquidity. I'm expecting price to rally to fall into this fair value gap. This is a weekly fair value gap. Now, once price gets to this point, I will watch price to see if price wants to continue going lower. There's a manner at which price,
Sorry. I said you are taking buy side liquidity. Is it
yeah,
the fair value gap that you are referring to as buy side liquidity now?
no, I'm talking about this high here. Are you seeing this
Wait,
high?
I can't see.
Okay, wait.
Okay. I've seen it.
Yeah, there's a high here. So this is what I'm referring to the buy side liquidity. So yes, price has taken the buy side liquidity. So now I'm expecting price to go into this fair value gap. Now, there's a manner at which price will behave at this fair value gap. Now, let me know if it wants to bounce here and continue going higher or it wants to break through. There's a manner, and when it happens, you also will know. If price breaks through it with full strength, then expect that price does not want to find support here. But if you see price rally, maybe falling down slowly, and then you see it creating this 3 candle pattern, which is already created here, you expect that price might probably find support here to continue rallying higher. But if not, if you see huge displacement and price breaking through it, then we would watch this inversion fair value gap to see if the same thing will happen here. If price would actually also break through it with full speed or find support by printing that 3 candle pattern, or there's a way manner at which price will act around this point, or if it starts to consolidate in a manner that it wants to continue going higher, it will tell us that okay, price wants to find support here or here. But at the moment, I am looking at what? This fair value gap. Now, what would change my bias? If price, let's say on Monday, if price begins to rally on Monday, like Monday prints, and then maybe it goes down a little, because you can see that there's a fair value gap here. Let me expand this. There's a small fair value gap here. Now, price can find support here and continue rallying higher. Now, what am I watching out for? I don't want to see Friday's high taken. So this here is my deal breaker. If Friday's high is taken, then I will change my analysis. So I want to see this high protected and this candle here become what? A bearish order block. So I hope we can see how I'm analyzing the market. Now, markets might actually even consolidate like for a moment and then continue going higher. That's a very that's a very good possibility. Price might consolidate maybe 2 or 3 days and then continue going higher. But I'm watching out for this high. I don't want to see Friday's high taken. I would love to see that Monday prints lower and then maybe Tuesday forms the high of the week, finding resistance in what? This bearish order block here. Because this order block has not been confirmed until this low is taken. So I want to see Monday print lower and then probably create a fair value gap or a displacement for Tuesday or Wednesday to return back to this order block for price to rally lower. So if we see that happening, then clearly we know that price wants to go lower. So it is very clear, very, very clear. So I'm expecting Monday to be what? Bearish. Monday might just print a small candle here and then Tuesday bearish, or maybe print something here, then Tuesday retrace into this fair value gap before running lower, whichever. I don't want to see this high taken. So that's my bias for the dollar. And you can see here, we still have a little range here. So another funny thing that can happen is Monday going higher, closing this gap before running lower. But if this gap should be closed, then I'll be expecting that this high here, price should run for this high. And if these highs are taken, then I'm looking forward to this high. The probability of this highs to be taken will increase. So Monday will be a determining factor. This is also a very good reason why people don't, or people actually wait for Mondays to be printed, because it's not very clear. Hello?
Yeah, I'm the one, sir. Please, I want to know the gap you're talking about.
The what? The gap?
Yeah.
Okay, good. This gap here, we still have, this gap is a weekly time frame gap. You can see that we still have gap here from this high, yes, to this low. So there's a gap. So we still have a gap here. So price might still want to run. So if this gap actually is taken, that's what I'm saying. I don't want to see this high taken. If Friday's high is taken, probably want to fill in this gap, probably want to go for these highs and then probably these highs here. So we already know where market is likely to go. At this point, we are in a premium from this range, from this high to this low. So I'm expecting price to rally lower. But with the strength, you can see how dollar is moving very fast. So this is very, very fast. This is telling you that either price wants to run higher to take this high, or price is repricing, sorry, or market is repricing into this range for it to continue going lower. So it happens like this. You notice that sometimes you see price reprice quickly and then give an opportunity for what either buyers or sellers before continuing in that direction. It usually happens. So most times that's why I still also advise that you watch the 15-minute time frame, watch the 1 minute time frame, watch the 5-minute time frame, like, especially the 15-minute time frame. Try and predict where price will go. Just watch it. That's what we call tape reading. When you watch all those things, it becomes second nature. It becomes part of you. You begin to understand how price moves, and price is fractal. Anything you see in the smaller time frame it happens in the higher time frame. Imagine you can predict price movement in the smaller time frame. It means you'll be able to predict price movement in the higher time frame. And why are you using the smaller time frame? Because it's happening very fast. You don't have to look at how we have to wait for a long time. This thing I just said now, we have to wait for 24 hours for it to occur, for it to tell us that okay, price is not going to continue lower or price is going to go higher. But in a smaller time frame, you are watching it, you are seeing it happening very fast. And since price is fractal, if you can predict time frame, smaller time frame movement, you'll be able to predict higher time frame movement. So that's just the whole goal. So I hope that's clear. This high here is my deal breaker. I don't want to see this high taken. I want to see price run lower for this fair value gap. Now, as you can see how I transpose the weekly fair value gap to daily fair value gap. And there's no fair value gap here except this one here. So this small thing here. So you might draw a weekly fair value gap and daily time frame, you will not see anything. It doesn't mean that that weekly fair value gap is not useful. You can still use it even if you don't find it in the lower time frame. You just want to outline it out so that it will be transposed to your smaller time frame. So the 4-hour time frame, you can see whenever I see something like this already, I do not expect price to start running higher. When you see a quick move and then price start falling like this, usually if just one candle rallies higher and then immediately you start seeing candles, maybe small candles falling down, already probability or the chances of price start rallying higher to take this high is very low. Usually what you see is maybe something like this. Maybe price will just go high like this, something like this, then drop. Usually. Now, I've seen this based on experience. You understand? It's not like this is a rule. Like you see something like this, like, I'm just using my experience too. And this is experience that I can't just give you. I can explain it, and you have to go and see it yourself in the market. So usually, once one candle prints like this, and then you see smaller candles falling after this huge, maybe a one candle goes very high with a huge range, and there's something like this happening. Usually, probability of price running high is very, very low. So you can see the same thing here. So I'm expecting bearish prices to where? This point. So you can see how price rallied higher and price did not fall. And even price began to fall maybe to this point here. I wouldn't expect price to start rallying higher. You can see the same thing happening here. All right. So like I was saying, you can see this huge range. Had it been price fell, like this is something you also want to go and check in the chart. You see it happen. Had it been price began to fall up to this point here, the probability of price rallying higher becomes very low. That's why I was telling that I want to see price break out from this range. I don't trust entering at this point. You see, from this high to this low. I don't trust it. When you see a
Sorry
huge
to
S, you see?
But that candle was NFP, right? That was that
Yes,
Friday.
yes. That's what I was going to say. Especially all these high impact news like CPI, NFP, all those news. You don't want to go the next day and start trading. You have to be very careful. In fact, let me go say it. Whenever there's a huge range, expect the next candles to be printed to range. Do you understand? When you see the daily range, huge volume, expect that the next day there will be less volume. And you can see it here. It happens all the time. When you see, and it happens in the 1 minute time frame, imagine you just see price move like this. Don't be too quick and say, okay, see this fair value gap. Let me just enter here. You just see that price will take time before it goes higher. So when you see this huge, you want to wait for what? When market is quiet. You want to see displacement and then wait for market to be what? Quiet. To show all these quiet moves first. Then look for something, either a run of low or a break, or just a pattern on the entry models. Then you can now enter. So this is a 1 hour time frame. like I said before, I wouldn't want to enter in any of these places. I wanted price to break out first because price could start going lower. And once price start going lower like this, it will tell me that, okay, chances that price wants to go higher is low. So I wouldn't be looking to buy dollar anymore. I'll be looking to sell dollar. At the point price got to this, when price was at this point, I was already bullish. I don't know if I took a trade. I don't know. Because I could remember I was going to work, so I didn't have that time to open my laptop. But at this point, this was a Wednesday. I remember clearly. You can see how price gave that protraction. Look at it here. You can see this protraction into what this bullish order block, and then probably there's a fair value gap. Let me expand it. So I could remember as price was going lower, I knew because you can see how price broke structure. There's a break of structure here. Price retraced and then broke structure again. Abi? Okay, it didn't break it yet. But at this point here, it was just getting clear that price wanted to break lower. Higher, sorry. So although I wasn't confident enough, all I wanted to see was that I wanted to see the high taken first. So we are seeing the same thing happening here. See this huge range. This was is this CPI? I can't remember what it was anyway. You see this huge, and then price now is coming lower. It has filled this fair value gap, and then about to break this low. So we're almost seeing a break of structure. Remember, I said that market structure is also very important. You don't just look at price and say, okay, this is that. So we're breaking structure almost breaking structure in the 1 minute, 1 hour time frame. So probability of price running higher depends. Probably price want to fill in this gap in the daily time frame, and then do what, run higher. We don't know. So let's move quickly to the Euro USD. I'm wasting a lot of time here. Spoken too long. So I want to deal with something quick. There's something I want to deal with. I don't think we need this. So the same thing, just like the euro, like I said. Let's go to the monthly. So if we even look at it here, it looks like price wants to take this low. We're not seeing any gap. Now this gap has already been closed. So likely price might find support in this bullish order block to continue going higher to take these highs 1, 2. So that's what I think. For now, it might change. So this is a monthly time frame. So I'm expecting price to find support in this bullish order block. Why? You can see how we rallied, price ranged. After ranging, price took out these lows, then rallied higher, then retraced into this bullish order block. This low was protected. Price broke structure to the upside again, and the price is retracing down into the range, into this bullish order block. So I'm expecting price to find support here. Now, when you start seeing the highs taken and the lows being protected, it's also another telltale sign that price wants to go higher. Usually, we also see this too in a smaller time frame. I said before, time is fractal. When you start seeing that the lows are being protected, like we see here, see the low. This is too big. Let me reduce it. See, it's protected, but here it was taken. Although this one has not been taken yet, but this high has been taken. So once this high is taken already, we can predict that price wants to go for this high and probably this high here. Okay. So let's go down to the weekly time frame. We can see, I heard this was what I was talking about. Why I think one of you was thinking that price will find support here before going higher because we had this fair value gap. So we're thinking that price will find support here, then go to fair value gap. And I was like, no, it cannot happen like that. It doesn't usually happen like that. Why? Because from the daily time frame, see how price was consolidating and then boom, it broke out. It gave in that retracement to this fair value gap and then broke lower. So for price to start going higher already, to tell us that price is no longer bearish, is bullish. But with the way market, when you see price consolidating and then it breaks out from consolidation with displacement, it's giving you the direction of where price is likely to go. Do you understand? We saw that in the weekly time frame. See how price was ranging, and then what happened? Boom, it broke higher, telling us that price wants to go higher, and actually did. It went higher. So we can see another consolidation here again. Price did what? Broke lower. Think that it can't just consolidate here, break lower, then start going back. No, not necessarily. We want it to leave the range. So from the weekly time frame, we can see where do you think the next week will print? So, like I said before, I want to see price retrace into what? This. Although I'm not saying I'm bullish Euro USD and then bearish the dollar. Like I'm expecting dollar to start going lower and lower. No. I'm just saying I'm still bullish dollar, but I expect dollar to be bearish short term into this fair value gap before continuing going higher. And how it will react here will tell us if it wants to continue going higher. Remember, this is what market maker buy model. I even forgot to explain it. This is the what original consolidation, reaccumulation, smart money reversal. Remember, there's SMT divergence here. Find this price is price supporting what is consequent encroachment from the weekly time frame. Sorry, monthly time frame. The midpoint of the close of this candle and the low of this candle. This is the consequent encroachment. You can see how the bodies respected it. If you cannot see it here, you can see it now. So from the daily time frame, what happened? Price reversed. Now this is what first stage reaccumulation. It was very fast. I don't think any of us caught it. Remember, I was saying I expected this week to be what? To form the low. Before Tuesday even printed, I don't know. Tuesday was printing that day. I can't remember, but I know that before the week was complete, I said Tuesday will form the low and then Thursday the high. You can see how it happened. So this is first stage reaccumulation. You can see how price trying to go lower to give a second stage reaccumulation. If you're a swing trader, you'll be expecting to buy as price retraces into this fair value gap for a run higher for this high and to fill up this fair value gap. So I'm not saying I'm bearish totally for price to start running. Okay, I think maybe I even mentioned that. I don't know if I said that, but if I said that, I'm sorry, it was a mistake. I'm not expecting price to start running lower to take these lows and these lows and these lows. No. It depends. So price might actually, if I mention it, I was trying to say that it depends on how price reacts here. So if price probably breaks through this point, I'm expecting price to continue going lower. But if price tends to consolidate, maybe break structure in lower time frame, breaks the high in the 1 hour or 4 hour time frame, or gives it an SMT divergence or something, tells us that price wants to go higher, then what happens? We continue to buy. So a lot of talking too much. So I'm still expecting euro to go lower, but for short time being, I'm expecting a bounce into where this fair value gap here. Sorry, let me just draw it out. So this is my drawn liquidity. So I expect price to run lower. Why we're in a discount? Probably price wants to go into a premium before continue going lower. Our prime actually go above this and find what resistance in this what? Let me outline it. This bearish order block. So you can see there's a bearish order block here. It's clean. What are the 3 things that he has that makes it a high probability order block? Who can help me? Okay, let me not waste time with that. Maybe point this meeting. Okay, blessing is back. Samuel, Fortune, Goodness, Elijah. Okay. So don't worry, you don't need to talk. Let me just say them. It has a fair value gap, it has a full range, and it has taken a high. So it is a high probability order block. So if price should get to this point, if you're a swing trader, you can sell. I'm not saying that if you sell here, you get profit. You might not, but there's a high chance that you will actually profit from selling here. You might go down to a lower time frame and look for a breaker block or another block again, and then sell. But meanwhile, I'm expecting price to rally into this fair value gap. I'm tired just now. Let me change this to what color? Purple. Visibility, we should be able to see it in the daily time frame. So these are drawn liquidity. Now, you can see how it merges with the inversion fair value gap. So these 2 places, price might reach for this fair value gap. These are weekly fair value gap, or keep on going higher to this daily order block. But I don't know. It depends on how price reacts towards this inversion fair value gap. So I expect, see how price bounced on this fair value gap and then broke through it. It returned a bit, then rallied, then fell lower. So if price should break through this inversion fair value gap, likely, I don't know. But this is my drawn liquidity. I'm expecting price to rally towards this purple line. So I'll leave it here. Although I don't like to see my charts clumsy like this, but let's leave it like this. So let's see what happens. So like I said before, just like I said in the dollar, I wouldn't want to see this low taking. That is Friday's low. I want to see price continue rolling higher. So you can see price reacting from a daily bullish order block. The daily bullish order block is also sort of a high probability because it has internal liquidity, short-term low, fair value gap. So most times when you see order block in the opposing side, it provides a bounce. I don't know, it usually happens. See the same thing here. See how price bounce in this order block here before rallying. This is not really a good example. Let me look for a very good example. Let's see. You see this price was bullish, but you can see how price bounced in this bearish order block. You can see how price hit it. What happens? it came back down and then finally broke it. Usually we see it happen in price. Let's see. You see this bullish order block. It's not very clear, but you can see how price bounced. Why do you think this keep happening? It's not random. Do you understand? They are unwinding the orders. I don't want to use this time to explain because it will be another lecture again. But what they're doing, they're unwinding their orders they placed here at this point. Let's look for another example again. You see, it's not really a very good example, but you can see how why did price hit this order block here? Let me draw it out. See how price hit this order block. It reacted a little bit, then broke through it. The same thing here again. Hit it, reacted a little bit, then broke through it. So because price is bullish most times, that's why we want to use those spots as target. You can use order blocks, breaker blocks as target. You use them to take partials. It doesn't mean that you collapse the whole trade, but once price gets to that point, you just take partials because you're expecting price to bounce away. So if price retraces, you might enter again. Maybe you add to your position. Let's say you're entering with 5 lots, and then you take 1 lot. If price retreats, you might be entering with 5 minis instead. That is half a lot size. So it's just a way of managing your trade to get higher returns in just a little trade that you might have taken here. So that's that. Ooh. So if we go down to the 4-hour time frame, we can see something beautiful is happening here, which is the last thing I'll just talk about before I go to gold. I won't talk about British pound. I don't know, just we'll roughly look at British pound. So here is the market maker buy model. I don't expect price to. So we can see it here clearly. Let me just take this away from here. This is what initial consolidation. I'm sure I will release a video on market maker model, explain it comprehensively. But what I want to do is I want to do a little research so I can improve it better and give you guys what nobody, probably just what I'm thinking, what nobody has actually given. Why I'm saying this is because I actually struggled with market maker model. I struggled with it for a very long time, and there was no anybody that actually explained it well for me. Although it's something that you learn by yourself when you go to the chart, but I'm looking for a very good way to bring it together so that you just see this, see that, and then you're able to tell that, okay, this is a market maker model and how to use it. So this is original consolidation, and then you can see here, this is smart money reversal, price is finding support here. You can see this is what we call a breaker block. This is a 1-hour breaker block, just because of it's too, like, I don't want to just go in depth into it, but this is a market maker model. If you go down to the 15-minute time frame, we see it clearly. So see how price consolidated, reversed, using the word inversion fair value gap. So you can see how price reacted in this fair value gap and then broke through it. As soon as it broke through, what happens? It found support where in the London Q zone, and then what rallied. So this is a unicorn model. You can see how price. So this is first stage reaccumulation. Second stage, let me just draw it out for us. This is the second stage. You can see how price finds support in where fair value gap. In what time frame? In what Q zone? The New York and the London. So these are opportunity for you to buy here, and then even here. This is what third stage, what reaccumulation. What can we see here? This is what a bullish order block, but it wasn't completed since it's Friday. I saw this happening, but I didn't want to go for it because my intention was price to run for this high. This is what we call the unicorn model, the last stage of the what market maker model. So I expect momentum, but because it's a Friday and we're almost at the end of the day, I didn't take the trade, and I don't expect price to actually even rally to this high because the day is already dying. So I love. Okay, who is talking?
Like me.
All right, you have a question?
And that other block that you just highlighted, right?
Yes.
The 3 criteria that you made mention of, does it meet the 3 criteria?
No. Thank God you asked this question. It must not meet the 3
Does it?
criteria for high probability order block, right? Right, Fortune.
Yes.
So I said it in the video is because you see that's the problem of watching video halfway. Go and finish that video. So I said that it must not meet all the three criteria if you're looking for a high probability order block. Now, what does it mean to say high probability? High probability is not something that must be, it's just what increases the probability. So if you have a full range body, fine. Then if on top of that, or added to that, you have a fair value gap, good, it increases probability. And then if the other block runs a low, it further increases probability. So it's just stacking up confluences that increase probability. So you may just see one. You may not go see any of the three, but probably you understand other flow. You understand maybe there's something else that just helps you know that market wants to go in that direction. You can trust. Like if you look at from this monthly time frame, you can see that there's no any this. Where is that other block I was drawing? See this other block here. It doesn't really have. Okay, this one does because it's taking a low full range and it has a fair value gap. So price reacted, but this one doesn't really have any of those three. But I'm expecting, and this is a monthly time frame. Most times, this is how price move in monthly time frame. You don't really want to see high probability or this. You don't really need to see them. So you see price clump up. Now, mind you, price might not. I'm just giving you what I think. It doesn't. I'm not telling you what will happen. I'm just saying what I think will happen. Price might just run lower with all these stories, all the time I've wasted to tell you this and that. It might not work as I've said. The only value you will get is you will just see how I analyze the market and learn from it. You just learn from my experience. You learn from the way market moves. That's just the major reason why I'm telling you what will happen. I'm not telling you so that you will say, okay, London will buy. Let's go and buy tomorrow. No, there's no. I'm sure many of you are not even trading yet. So it's just to give you an insight of how the market moves. So, all right. So going back to what I'm saying, the other block has just two. As you can see it here, is a full range. That's
But I think we took a look.
Yeah, it's also good. It's I was going to say it, but
They just told me that.
I wouldn't
Yes.
classify this low as significant, although it actually takes a low, but I would have preferred this other block taking this low. Yeah, this will be more significant, but this low doesn't look more significant, but you can classify it as that. You know, when I say taking a low, if you see price take a low and price rallies away from that point, and when you see that happen, why you want to see other block take a low is because it increases the probability that price will not want to take that low again. Do you understand? Had it been this other block took this low and broke structure to the upside, it will be very low probability for price to start rolling down again to take it slow. But if this low is taken, there's still a probability that price might still want to go lower. But many other things we can see price has broken structure to the upside and there's a fair value gap. So there's displacement already is enough. So I hope we get why. It's not, I don't just pick, okay, candle must take a low. No, I'm sure even Samuel should also know this very well. And many of you too also know that if a low is taken, it expect that low to be taken again. All right. So now, I was saying that I love how mark price printed like this. So it did not take this high. So I'm expecting this high to be taken. Although the wicks do the damage, the body tells the story. Probably at this point, price should have maybe taken this high. But looking at it, it's reaching out for this high, this weak high here. So this is my drawn liquidity. So what I'm expecting to happen is Monday should open here, create market open, and then give an Asian range. If it gives an Asian range and it runs below the Asian range, I'll go down to a 1 minute time frame and look for one of the entry models for a buy. So, but if Asian, because most times Monday can just print, you just see a gap up, and then Monday will just keep printing higher like that and keep going higher. Usually happens like that. If I see something like that, I don't usually want to trade because you just put yourself in trouble. Except there's a very clear drawn liquidity somewhere here. Do you understand? But looking at this high here, this high is not taking yet. And then also in the dollar, you can see that the low has not been taken, but you can see how very close it is to the low. It's close to it to the low. So there's a high chance that this low will be taken. If you look at it, do you think price will now start? Now look at it, guys. This is how you look at market. Do you think price will now start going, will leave this low and start going higher? No, there's a high chance that this low will be taken because price is very, very close to this low. And even if it's not taken, probably it's only creating liquidity. If it rallies higher and doesn't take it, I expect that Tuesday will run lower to take it. Monday might just range here and nothing will happen. Do you understand? So, which is also better because I would love it to be on Tuesday. Tuesdays usually present good days for trades. So Tuesday rallies higher, maybe creates a range, something, just give me something, maybe other block, fair value gap or something, or breaker block. I'll be selling lower. But tomorrow, the probability of this low to be taken is very high. See how close it is. Let me just draw it out. See, it's very, very close. So you might even see a gap lower. Okay, so that's that. Let me come back. So I said I want to see price maybe range before taking this high. To complete what? The market maker buy model. So I'm combining the market maker buy model, daily bias, and every other thing. So what second stage reaccumulation? So first, second, so I'm expecting the third, probably these other blocks or whatever it may give me. So lastly, we're going to look at, let's just briefly look at, I'm sure this is very boring for us. A lot of talking. So British pounds, let me just take this out. This is a monthly time frame. So just the same thing I said. Remember, I said that this low will be taken. I think I asked, it was Samuel that answered. I don't know, I can't remember. Well, he said to be better to take this low, and it was actually taken. So when you see a low taken and you see this rejection, expect price to rally higher. Are you seeing it again? These are the ways you read price. See this huge rejection here. So before I go into the British pounds, I want to talk about the gold. Let's talk about gold first. Sorry, I'm skipping. Many of you, especially, I wish Gordon was here. Gordon is not here. I don't know why. Gordon was asking me if the gold will be bullish. I told him, I think it was at this point here. I don't know when he was asking me if gold will still be bullish. No, this was where it was. Now imagine gold is here. Look at gold though. Let me show you something. This is what Friday. I think it was a Friday. So I know he asked me in a weekend time. If it was me, I'll be scared. It was me before. I'll be scared because see gold, it has been rallying. I know when gold is rallying, there's this psychological pattern we fall into where we now say, okay, since that we're rallying, it has rallied too much. Now let's start selling because gold cannot go higher than this again. Or there's a chance that price will want to run lower because it has been going on for too long. Now that's what we call calling the tops. And I've felt for that so many times. I always try to call the tops because I'm sort of a contrarian trader. I love to see buy side. I love to see liquidity taken, then I go down lower time frame, then look for something and sell or buy, whichever is the case. But if you look at this now, what most of the time we are looking for when market is rallying, we're waiting for a retracement, like maybe markets should just retrace. And usually we don't get that. You can see our price, although we see blips of retracement. And I also told him that I wouldn't want, I think I said it in a group chat, one of the analysis. I said I don't want to see price start rallying lower. No. If you start doing that, then price wants to go lower. It's just the same thing I said in the dollar. You see this huge range. You don't want to see price start going. If this price start going lower now, there's a lower chance that price will be able to continue going higher to take these highs. But you can see our price just filling this favor look at. This is what we call the institutional order flow entry drill. We are seeing it here again. So the moment price start coming lower to take out this low, then probably the assignment, I'll put it like that, of the institutional order flow has been accomplished. That's how institutional order flow works. So you can see this fair value gap again. Price came lower and then boom. Now we are still going. This is the all-time high of gold. When price at all-time high, people usually get scared. They are like, it will retrace, but it will not retrace. And I also said something last week. I said, just because dollar is bullish, it does not mean that gold will not be bearish. It does not work like that. See how dollar has been bullish. And what has happened to gold? Gold has been bullish. So don't just say, okay, since gold is bullish, no, if it's like that, everybody will be a millionaire. It does not really work like that. Although the dollar is paid against the gold, but this dollar index is not just dollar index. It is dollar against the foreign currencies. Dollar index has its own percentage. I don't know if you understand. This is not just dollar. Dollar index does not just measure dollar. It's measuring dollar against euro, against British pound, against the yen, against the odd, and against the card, against the six. I think there are six major currencies. Let me be sure. Euro, British pound, yen, or the card. 5. The 5 and New Zealand, that's 6. I think I'm correct. So they have their percentage, I think, but euro has the highest percentage. I mean, dollar after dollar, then euro has the highest percentage. So dollar against this pair. So you don't just say, okay, dollar is going lower. Let's start buying gold. No. So you can see the gold, and at this point, I will still call gold higher. Gold is still what? Bullish. I'm not even going to say, I'm not even expecting gold to start going lower. I remember I said that I'm expecting price to find support in where? This bearish order, this bullish order block, breaker block, sorry. So this is the breaker block, and you can see how price found support and is what? Rallying. This is what I called. So many of you would have used this strategy like I gave you. I gave it in the video. Many of you did not. I don't know why many of you are not using it. You don't like it. It's too, you don't find the opportunity all the time, Abi. You will see that your problem is not strategy. That's why I'm not even in a rush to give. You know, I can just start giving you strategy. I say, okay, do that. Do you know how many? I have multiple. I have strategies, to be very honest. Okay, we're almost running out. I can start, and if I start giving you strategies, you'll just be happy. And it's not so many things. That's not your, you know, if you go on YouTube, you see different strategies. They are just like candy. They're just giving you candy. You take a lot of sugar and it's not helping you. Instead, it's even damaging your health. You move from one strategy to another. That's no, I don't know how many times I'll tell you. Although I'm going to release, I already told, what's his name? Samuel. Yeah? Okay, they're still here. I already told Samuel I'm going to release my strategy this week instead of next week so that you guys will just look at it. Now, I'm not saying that it will not help you, it will help you, but I'm just trying to tell you that strategy is not necessarily what you need like that. And I explained last time we made that when you receive this strategy, that there's something you need to do which is called back testing. Then after back testing, you forward test. Those two things are what will do the miracle, not the strategy. Strategy is like a vehicle to help you practice, help you gain knowledge about the market, help you gain knowledge about yourself, and help you gain knowledge about what type of trader you will likely be. I hope I'm really able to even communicate properly. But I just hope you understand what I'm saying. So trading strategy is just to help you. That's why you don't need to go and form your own. If you can form your own, fine. But it gets faster when you get somebody else's own, and then try and work with it closely so that you gain knowledge about how market moves, gain more knowledge about the strategy, gain confidence, then use it to practice on the market for you to become a better trader, because it's that for testing. Now, for testing has many rules, and that's why education, when you're teaching something, you have to bring it to a point where it helps retention. Like if I give you, so if I tell you something, I always try to say, okay, there are two important things. So I'll put it like that here again. There are two major things that for testing does for you. Number one, there are many other ones, so maybe I don't even know about them, but and there are also others that I know, but I'll just mention two that are very important as it has to do with what I'm talking about now. Because I'm sure we know what for testing is, and I explained the benefit of back testing the last time. If you can remember, I said back testing will help you. If you get a strategy, it will help you learn about the market. If you use other blocks, for the sake of those who were not here, I'm saying, as I'm repeating myself, if you use other block as a strategy, what happens? If you backtest like 30 sample data, looking at 30 examples of other blocks, what happens? You become very good, very skillful with other blocks, because you are able to tell the right other blocks to use. In fact, it will be something that nobody will teach you. You just look at this chart, you say, okay, this other block, Kai, I don't want to use it. Then you will now form your own rule and say, okay, since I have noticed this and this and this and this, based on my own personal experience, my trading strategy will be that any other block that does not have fair value gaps, or any other block that does not have this and that, I won't use it. I only use other blocks that have fair value gaps. And that will be your strategy. It will be your own. So you're not copying the person's own might be the one that runs a low, takes a high, has internal liquidity, full range, blah, 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 blah. But you will not carve out your own, because now this is what you personally see. It's what you personally resonate with. So you are making your own trader out of that strategy. So you have learned what about the market. 2, you've gotten your strategy. Then 3, you gain confidence. If you have confidence, you know that this strategy works. What happened? When you are in a losing streak, you don't just say, I'm losing. Let me change strategy. No, you stick to it, because that's what you need to do. You need to be consistent with one strategy. That because trading, you're going to lose. There's a session I want to go you guys. I just realized that if I keep talking like this, I have a lot of things to say. So now let's now go into what for testing. What are the two major things? Number one, you are able to see it before it happens. Now, you will now notice that hindsight and foresight are two very, very different things. You will discover that you will start seeing things after they have happened, and then you'll be wondering, how was I not able to see this before it happens? That's another skill again you have to build. That's why most times that is even why one of the reasons why I'm very much demonstrating, and it has helped me so much. That's what we call for testing. You demonstrate it or you tape read it, you just watch it. The ability to see it before it happens is another skill. One skill you need to get from backtesting is to be able to see it clearly. If I look at the chart now, what I'm seeing is different from what you are seeing. As I'm looking at the chart now, I'm seeing many things, and you are seeing many things. And what I'm seeing is based on my backlog of experience, backtesting, trading the market, and every other thing, and yours do the same. So that's one skill. Another skill is to now be able to see it before it happens. That's a very important skill. You will now discover that if you use a strategy, or maybe the strategy I'll be releasing very soon. I'll release it this week, I promise, don't worry. I'll release it. When you now back test it, you discover that okay, to now see it before it happens is another skill you now need to learn again. So we are seeing where the work is now when it comes to strategy. So it's not necessarily the strategy, it's just how you use it, is use it as a tool. So if you're not really having this understanding, you'll just be looking for strategies up and down. Just look for this, looking for the next hot thing, this, that, and then you end up not being in any position. You're not going anywhere. So that's the first. The first one, like I said before, is to be able to help you build that anticipatory skill, to be able to see it before it happens. Then the second is that you are able to, when you practice it for testing, it gives you that leverage of being able to build a psychology. Now, I don't want to go deep into that because that one, I'm actually reserving it for the future sake, but I'll just give an overview. I'm sure many of you have, and that I was going to tell you guys to go and read this book, how will I forget the name of this book? Trading the Zone 1 and The Disciplined Trader, all written by Mark Douglas. I read those books 4 times. I mean, 2 times, 3 times Trading the Zone, 2 times The Disciplined Trader. If you've not read that book, please go and read it. I don't want to even say you are not ready. Go and read that book. It doesn't mean if you don't read it, you will not succeed, but it's just one of it. Go and listen to most of the successful traders. They've read that book.
Which book is that?
Okay, I'll send it to the group chat. I'll send it to the group chat. The Trading the Zone and The Disciplined Trader. I have the hard copy for The Disciplined Trader, but I don't have but I've read Trading the Zone, and they also have the audio book for it. So after now, please, if maybe you don't have anything you are doing, go and read that book. Read it once, maybe read it twice if you can. So what you will now be doing with for testing is now practicing that mindset, because it's a mind thing around market. That's when you've now leave the area of technical into psychological, you've taken step 1. That step 2 now is where you now use that for testing, because sometimes you will not see now you can tell when it will happen. Okay, market is moving. You know that before it happens, this is what happened. You are very skillful in that area. Second area is the ability to follow your rules, because now you've made your own strategy from this person's strategy. Maybe you got it from online, from me, from ICT, any of ICT students. You have your own unique strategy. You have everything written down. You have your rules. You say, okay, the other block you use is the other block to favor the gaps. That's all. But you will discover that you have this skill, but you are entering where you're not supposed to be entering. You are not seeing the market, but because you have this whole knowledge about market movement, you just believe that. I'm sure this should also be happening to somewhere. You just know that, okay, this, that. You understand market maker model. Somehow, something, probably market will find this is market reversal, then you just enter. and you discover you lose the trade. And then you'll be like, why did they not follow my rule? So that's where forward testing now comes in. That's the second role to play. Now it has other roles to play, but that's just that. So I've been able to speak a lot. Just to let you know that strategy is not really what you need. You have to have this understanding first before you should try to get any strategy. So I gave you a breakout block strategy, like I explained before. You want to look for a breakout block in a higher time frame after determining an institutional order flow is bullish. So I said it before, you want to wait for what the Q zones. So once price gets to the breakout block, you can see you have 1, 2, and then you use the extra range for your stop. So if you don't know about the strategy, just go and watch it if I mean it this time. So, and I explained we'll use the extra range for the stop. That you don't want to see price. What is it? Remember, now there's something called the central bank dealing range, and I've not taught it before. I don't think there's any need to teach it. It's just a complex stuff. These are the core ICT courses that I learned years back. So there's no need, but we're applying it here. So you want to use it as a stop, either here or here. So if you put your stop here, you enter here, fine. You don't need to see any jumbo, maybe anything. Just want to see price, touch it. Then use the range. You can even be entering here yourself. They use this extra range here. So I won't talk too much about the strategy because of time. Okay, so I guess we do not have any question. In the absence of no question, I wish you all good luck tomorrow. So let's watch the market together and see what happens. And a wonderful good night. Thank you very much.
Thank you, sir.
Thank
Good
you.
night, sir.
Thank you, sir. Good
All right.
night, sir.
Thank you very much. Good night.
Good night.
All right, good night, Fortune.